You're listening to Dear Joseph, the podcast where we answer all your financial questions. This is a pure conversation podcast. Disclaimer, I'm not a financial advisor, and nothing I say should be considered as financial advice, but purely for entertainment purposes. This week's question comes from both Ben T and Noam M. They asked a very similar question. Dear Joseph, how can I diversify my portfolio? So I think the prerequisite question to getting to how can I is why should I diversify? So there's something so to answer that, we have to understand what is risk. So there are two types of risks that we associate with the market. One is systematic risk, which is the risk of the entire market. Can the entire market succeed or not? And there's non-systematic risk, which is or individual risk, which is what risks do individual companies face? Now, there are different ways to think about individual companies' risks. For example, take Coca-Cola. Coca-Cola is a company that's very affected by the dollar, meaning even if they beat their sales on every metric internationally, because they have so many products international, if there is a bad rate from the dollar to whatever countries are they're trading, then they could actually have a lower profit or a lower revenue compared to previous years, meaning their entire earnings is dependent on how the dollar does, which is not such a which is a little counterintuitive. Meaning they could be selling tons and tons more of a soda or whatever they sell. Have a lot of different products, but because of the dollar, they would actually lose out or have a worse quarter than previously. Another thing to think about maybe is also interest rates. You'd think interest rates affects the entire market the same, but it does. Lower interest rates are bad for banks. So a company like Bank of America, which it does have some non-interest related services, and the banks that are outperforming currently are the ones that are diversifying into non-interest rate based or dependent businesses. But you could see that a bank which is dependent on interest rates, or a majority of their profits are dependent on interest rates, how they can be negatively affected by interest rates, where other companies, for example, that require heavy amounts of debts might benefit from interest rates because there's less risk on their end. And so you could see also from the banking perspective that other banks like J.P. Morgan, for example, because they realized that interest rates are going to be low, they said, well, how do I diversify away from interest rates? How are we not make ourselves less dependent on this risk? So they created new outlets like trading platforms to be able to circumvent that. Once you understand that every time you invest, you are now taking upon yourself a risk, you then will say, well, what kind of risks is my portfolio susceptible to do? Meaning, if you are invested in an individual stock, or a certain stock is taking up a big percentage of your portfolio, then you are making your entire potential portfolio susceptible to that type of risk. So, if, for example, Coca-Cola, you are invested in heavily in Coca-Cola, well, then the exchange rate will be a big factor, or health food, the health movement. Coca-Cola even tried to get into the health movement and do things like vitamin water, but it flopped. So that was a risk Coca-Cola investors took. Now, obviously, Coca-Cola didn't drop, and their prices, still towards all-time highs, but definitely the stock price has been hindered in the last decade or so. Meaning, risk isn't just the stock will flop; it's that you won't have such a great return on it. And when you're thinking about how your portfolio is, you want to kind of optimize it compared to whatever risk you are comfortable taking. So if you're willing to play the US dollar rate and the health food risk, maybe that's the portfolio for you. But I don't think most people, number one, understand what risks they're taking on themselves when they invest in portfolio. And number two, they don't realize that just because they get excited about a stock doesn't mean um, it'll be good for their portfolio. And if they're really planning on saving it for a long time, they might actually be losing out in the long run because they could be potentially buying a more optimal portfolio for what they're comfortable with compared to what they're compared to what they're doing now. And when you want to think about what kind of portfolio you're looking for, it doesn't make sense to play around so much. Day trading, by every study almost ever, you find that people who day trade, don't do well. People who don't make optimal portfolios don't do well. And in fact, even people who do have optimal portfolios, there are certain ways to even beat out, how to, in a given portfolio, optimize it. So I'll give an example of a good strategy. I'm not guaranteeing it. I don't know how it's going to be in the future, but a good strategy and a strategy where intuitively you look at it one way and you'd assume something, but really the other way was better. Take for example, there's S&P equal weight, which is the 500 biggest companies equally weighted, which means every company, it doesn't matter if you're Apple or Microsoft and you're worth almost $2 trillion, or if you're the smallest company worth only a few hundred million, that doesn't matter how big you are, your the amount your stock grows will equally impact the entire portfolio. Whereas, take for example, S&P weighted by market cap, which means the larger the company, the larger effect on the entire portfolio. Um, so a company like Microsoft, like Apple, has a much greater effect on the entire portfolio. And you see that in recent days, in the Corona market environment, you constantly hear, the market has at new highs. So what does that mean? So usually people are referring to S&P weighted by market cap. And if you take a look at some of the data, you'll see that, the top 10, the top 15 or so stocks are really, or largest companies are really uniquely built to be able to survive because either they have to do with shipping or like Amazon, or they have to do with media, or things we use every day like phones and like iPhones or whatever, Apple. So those companies are uniquely built to be able to weather and thrive in these environments, or Microsoft, software. But for companies that aren't weathered, you'll note that a majority have only recovered or are near recovery or a little above previous highs, meaning they didn't blow away the entire their market highs, and some even underperformed or went under. And there are new companies which took its place, meaning the in recent days it looks like that only a few companies were worth investing in. But if you invested in equal weight, you'd actually underperform. But if you look over time, you'll notice that over long periods of times, even when there are companies that are uniquely susceptible to thriving in any environment or in specific environments, have actually underperformed compared to S&P equal weight, meaning the diversity of the S&P equal weight actually ended up being a good thing. And the reason is because readjusting your portfolio to your risk level actually pays off. And it's been found in there's a lot of data on readjusting portfolios, and they found that if you actually readjust your portfolio, you can make an average somewhere like 2% annually or per year. This is definitely true if you look in the last 20 years for S&P equal weight versus market cap. I'm not necessarily saying to go into either one, or that's going to be true with your portfolio, but if you're comfortable with a certain level of risk, then it makes the most sense to weight your portfolio by that given risk and not just invest randomly. When you invest randomly, like most people I know, I know someone, I have some friends who tell me, I invested in this, Lockheed Martin, and then I sold it, and then I went into Microsoft. And then after I profited from Microsoft, I went into Apple. And then Apple just shot up recently, so I decided, now it's time to cash out and, go into Amazon. And sometimes they make money, sometimes they don't. But their portfolios are not created in a way which makes any sense. They're subjecting themselves to some risk as opposed to other. Um, I don't think they intelligently know what kind of risk they're looking for or what kind of risk they're comfortably. And in the long run, they're going to lose, even if they got lucky. How many times can you pick a winning investment? The statistics are not on their side. And if you're planning on saving money and creating a optimal portfolio, you should you should find a risk, you should find a type of portfolio which makes the most sense to you. I'll share with a little bit about mine as kind of understanding. Obviously, I'm not recommending necessarily to copy it. It could do horribly, it could do okay, it could do amazing. You never know. But I'm saying for my portfolio, I try to readjust it and I try to keep it at optimal levels to compare to where I to what I'm looking for. So I try to diversify completely. So I have a big portion of my portfolio in equal weight ETFs, and then there are a group of a few industries or companies which I don't want to be diversified in because I think they're going to outperform, but I want to be safe. I don't want to accept total, I don't want them to totally dominate my portfolio. So I invest in, segmented indexes, which I think will outperform, or indexes which are weighted heavily into companies that I like. And then I have something which I call my emotional health fund, where the idea is that I'll look at certain companies and be like, I can't believe I didn't invest in that. If I would have invested in it 20 years ago, I'd be the richest, I'd be a millionaire. So that I don't feel bad about missing these opportunities, like 2% of my portfolio is like play money. It's close to gambling, but I still try to optimize it to risk. But I'll invest in those companies where I think that they'll do amazing, and if you stay invested in them for like 40 years, it'll be the next Apple or whatever. You know, um, I I think just for just so I don't feel bad later, so I'm willing to say, a small portion of my portfolio will be, and I think I know how to pick stocks, and I think I'll be able to do well. But the key is I also readjust that regularly. Where if I make a lot of money from that portfolio, I'll actually take the profits and put it towards the rest of my portfolio because I want to keep it at 2%. Because I believe that my 2% where I'm really trying to do well, I think the readjustment is actually going to make more sense than to actually keep it in those companies forever. Meaning, uh, you know, let's say a company grows from 100 to $200 a share, from $100 a share to $200 a share. So then I'll sell half a share. On many platforms, it's very easy to sell half shares, and and every time it grows, I'll sell it, and then I'll put that towards wherever in my portfolio the portfolio is not weighted correctly. And I try to keep my portfolio at specific weights so that I accept the kind of risk I'm looking for, and I keep it at that level of risk. Now, to do it that meticulously, I don't know if it's necessarily so doable or people are really going to care enough. But I think it makes sense that when you're designing a portfolio and you're designing the way that you're going to invest, it should be it should make sense. It shouldn't be just throwing darts at a newspaper and hoping it sticks, or just guessing companies. Even if you do well, you are going to underperform just because you don't know how to properly weight your portfolio. What I what I think what I'm an advocate of, and I think makes the most sense, is to find some type of portfolio that you're comfortable with, whether it's S&P, whether it's Nasdaq, whether it's some other type of large index. Diversify your portfolio properly, and then if there are certain places where you think might outperform, you know, don't necessarily go into any individual company or any groups of company. Try to find an index that will be heavily weighted based off of that risk you're willing to take. Meaning, if for example it's microchips, so invest in an ETF, a semiconductor ETFs. There are a bunch of good ones. Invest in industrial stocks, whatever. Invest in a group of companies that makes sense, as opposed to just going wherever you feel. And then but to keep that side of you that thinks that you're going to perform if you actually know what you're doing, which most people don't. And I don't think I really like know how to play the stocks better than anyone else. If you really need it just for yourself, keep a small portion of your portfolio, but do not But if you're really planning on saving long term, do not make that a major percentage of your portfolio. And even if it grows, keep it in check so that your other portfolio can be optimized. And that way, in the end, in 20, 30, 40 years, however long your horizon for investments are, you can actually make the most amount of money you can. Thank you for listening. Make sure to like and subscribe, and make sure to follow us on Twitter.